Welcome to the Index Fund Review channel. On this channel, I review index funds and ETFs, looking at their past performance, the indices they track, the companies they hold, and so on and so on. In this video, I'll be reviewing the Legal & General Global Technology Index Fund. Let's see what it's got to offer. So for transparency, this video is not sponsored by anyone, it is not financial advice, and I do hold a position in this fund that we'll look at shortly, but first a few facts about the fund. So the objective of the fund is to provide growth by tracking the performance of the FTSE World Technology Index. That is the index to the fund. It's been around since the year 2000, so we've got over 20 years of track record, which is great. Not all funds make it to the 20-year mark. Many of them get closed for various reasons, for example, due to poor performance or not enough money invested in the fund, etc., etc. If you're a long-term investor, you want a fund that can stand the test of time. You don't want to have to move your money because the fund gets closed or whatever. This fund has proven its longevity, so I'm relatively confident it will be around for the number of years in the future. That's no guarantee though. The fund size is about £1 billion, which basically means there's £1 billion invested in the fund. The currency is in GBP, which is great for us UK investors. Don't have to worry about foreign exchange, and the fund is based out of the UK. So let's look at the past performance of the fund. I use Fidelity's investment platform to buy this fund. I've been dollar cost averaging into it since September 2019, or throughout the roller coaster year that was 2020. And at the moment, I'm sitting at a return of 27%. In real money, that's a £200 return on about £800 invested, which is a pretty good return. I'm happy with that. So I've been in this fund for over a year now. I am lagging a bit behind the 1 year performance, but it is normal to see some discrepancy between these figures here and your actual return, because these figures don't take into account when I actually made my investment. This 34% return, I would have had this if I made a lump sum exactly 1 year ago today, but I've been buying across the year, so I've bought some units at higher prices than they were a year ago, which has dragged down my performance a bit, but I'm not complaining. 27% is pretty good. Looking at the annualized return, let's look at the 5-year performance, for example. This means over the last 5 years, on average, you would have had 29% return per year for those 5 years. Looking at the annual return, these are the actual returns you would have had for each of the last 5 years. These dates over here need updating. It should really say January to December. So for 2020 and 2019, about 41% return, 2% return for 2018, 25% return for 2017, and 36% return for 2016. Again, these figures are based on making a single lump sum investment and then waiting a year for your return. So how does this performance compare to the market in general? If we look at the FTSE 100 total return, this includes dividends, and the S&P 500 net return, which includes net dividends reinvested, i.e. after foreign dividend tax. If you invested a lump sum 5 years ago of £1,000, it would have turned into 3,400 in the fund, 2,100 in the S&P, and 1,250-ish in the FTSE 100. Over 10 years, it would have turned into 6,000, 4,000, and 1,600 respectively. Apologies to anyone with a home bias. The FTSE 100 and the S&P contain companies across all 11 business sectors. Some sectors perform well, others perform badly, which drags down the index. The technology sector has been the best performing sector over the last 10 years. So with this fund, you avoid a lot of the badly performing sectors, hence the outperformance of the overall market. Will the technology sector lead for the next 10 years? Can't predict the future, but I'm willing to put some money on it. So what are the charges like for the fund? We've got an ongoing charge of 0.32% and minus 0.2% for transaction costs, so that's 0.3% overall, which isn't too bad. Note that these charges are already considered in the return that we looked at above. They are not additional charges. It's important to consider the performance of the fund and the fees together, not in isolation. Paying a little bit more for better performance is better than paying for a cheap fund with poor performance. The platform fee for Fidelity is a separate charge that's not shown here. That is an additional cost that you'll have to consider if you're going to use this platform. So let's move on from performance to what the fund is actually made out of, as in what companies the fund holds. It states here that the fund will not always own all the assets that constitute the index, and on occasion it will own assets that are not in the index. They say this is in order to minimize transaction costs, so the fund uses partial replication, not full replication, which is where the fund doesn't hold all of the stocks within the index. I won't go through the key investor document, but if you have a look in there, it states that the fund aims to hold at least 90% of the stocks within the index. So at least 190 of these 212 stocks in the fund should match the index, and maybe some deviation in the remaining 22 stocks. With 212 companies in the fund, you've got your eggs in 212 baskets. Although with all the companies being in the technology sector, you've got your 212 baskets effectively in one bucket, which is a risk for this fund. If we have another dot-com bubble, this fund will feel a lot of pain. The majority of the companies are large cap, with a few mid cap companies. Top 10 holdings are quite well known. We've got Apple, Microsoft, Google, Facebook. They make up about 42.3% of this fund. For comparison, these companies make up 17.4% of the S&P 500. Other household names are Samsung and Adobe. Some other names that are not so well known, Taiwan Semiconductors, who are the world's most valuable semiconductor company. They build chips for Apple, many others. Nvidia, who are working on self-driving software for cars, amongst many other things. This fund is globally diversified, but with it being a technology fund, it's no surprise that 80% of the companies, or 79% of the companies within it, are US companies. But you've got some exposure to Asia and Europe and Africa as well. So to end this review, let's give this fund a risk-reward score. Starting off with reward, it's got a 10-year plus track record of market-beating performance, so I'll give it a 10 for reward. And for risk, it lacks sector diversification, so I'll have to give it a 6. That gives an overall risk-reward score of 8 out of 10. Let me know your thoughts in the comment section, and I'll see you in the next video.